Did you know that 95% of Bitcoin's trading volume might be fake? That's right. Research shows most reported trading activity could be completely made up. But why should this matter to you? Because market manipulation like this affects your money, whether you notice it or not. Stick with us and we'll explain how these shady practices work, why they're so common in the crypto world, and most importantly, how you can protect yourself. This kind of thing won't happen to me. Other people might fall for scams, but me, no way. Meet Alex and Sam, two crypto investors with very different approaches. Alex dives in headfirst, always chasing the next big thing. Sam takes her time, studying the market and analyzing trends before she invests. One day, both of them notice a new token rapidly increasing in value. Alex is thrilled. He sees the price skyrocketing and decides to invest a big chunk of his savings right away, hoping to get rich quick. Sam hesitates. Something feels off. She spots unusual trading patterns and high trading volume for such a new token. Even though the gains are tempting, Sam decides to wait and watch. As the token's price keeps climbing, Alex is over the moon. He's texting his friends, telling them to join in on this once-in-a-lifetime opportunity. Sam, however, stays cautious, convinced the rise is just too good to be true. Then, almost without warning, the token's price crashes. It falls hard, leaving Alex and many others holding worthless pieces of you-know-what. What happened? It was a pump-and-dump scheme. Manipulators drove the price up and sold at the peak, and left everyday investors like Alex with huge losses. Alex is heartbroken. He lost nearly 90% of his money. It's a harsh lesson about the dangers of FOMO, fear of missing out, and why it's critical to do proper research. Sam, on the other hand, feels relieved. By spotting the warning signs and resisting the hype, she avoided becoming another victim of a scam. This kind of scheme happens all the time, and here's the scary part. It could happen to you. But first, why do so many scams affect crypto especially? Like any market, crypto isn't immune to bad actors. Manipulation can happen in any tradable asset, but the unique nature of crypto makes it especially vulnerable. One major factor is that crypto is still a relatively new industry. Its rapid growth has outpaced the ability of many countries to regulate it effectively. This creates legal gray areas where manipulative practices can thrive, leaving investors without the protections they might expect in more established markets. The technology behind crypto is advancing quickly, but policies haven't kept up. The gap between innovation and regulation makes the crypto space a prime target for exploit. Without clear rules to hold the players accountable, the risk of market abuse is higher, especially for new or inexperienced investors. Also, ever wondered who's really pulling the strings in the crypto markets? Let's take a closer look at the world of smart money and how they might be influencing the trades more than you realize. When we talk about smart money in crypto, we're referring to the big players, institutional investors, venture capitalists, exchanges, elite traders. These aren't your average investors. They've got deep pockets and extensive knowledge of market dynamics, and they're using that knowledge to their advantage and often against you. Think about it. Every time you place a trade, you're leaving a digital footprint. And guess who's watching those footprints? You've got it right, the smart money. They can see where retail investors like you and me are placing our bets, and they use that information strategically. It's almost like they've got a crystal ball, anticipating our moves before we even make them. But it gets even more interesting when we look at market makers. These guys are supposed to provide liquidity, keep the market running smoothly. But here's the catch, they've got a front row seat to all the action, and some of them aren't afraid to use that information for their own gain. Now throw algorithmic trading into the mix. We're not just dealing with human traders anymore. We're up against sophisticated computer programs that can execute trades faster than you can blink. If things are so bad, how do you spot market manipulation? It's not easy, but you can sharpen your detection skills. Let's see some common tactics manipulators use and how you can spot them. One of the most common tactics is wash trading, where traders create fake activity to make an asset seem more popular than it really is. You might notice unusually high volumes in a token, but the price doesn't move in a way that makes sense. Sometimes you can even trace transactions going back and forth between the same accounts, especially on networks where activity is public. Another red flag are pump and dump schemes, which often involve newly launched tokens. These tokens experience sharp price spikes driven by hype from multiple accounts on social media. But look closer and you'll see the liquidity doesn't match the rapid price increase, making it clear that the spike is probably artificially created. Spoofing is another technique to watch out for. This happens when traders open very large positions in the order books, creating the illusion of strong interest. But before these positions are filled, they cancel them, leaving other traders to react to false signals. In decentralized markets, front-running is a manipulation tactic where traders act on pending orders before they're executed. By analyzing the pool and order books, you might spot unusually large trades being planned, which is often a sign of front-running in action. Stop-loss hunting targets traders who set automatic sell orders at certain price levels. Manipulators push the price to these resistance areas, triggering those orders and causing sharp, sudden movements. These behaviors are often clustered around key price points. Finally, there's insider trading, where price moves before major news becomes public. If you notice unusual trading volumes or sudden shifts in price without any clear reason, it could mean someone is acting on information not yet available to the wider market. On-chain analysis tools can help you detect this kind of foul play. Tools like Nansen, Coinmetrics, and CryptoQuant let you examine actual transaction data, helping you spot unusual patterns like wash trading. If you'd like to know some more of the most useful tools in crypto, watch Top 10 Best Crypto Research Tools, and link is left for you below. Remember, in the world of crypto, knowledge is your best defense. By learning to spot the signs, you're already a step ahead of many traders. Stay vigilant, use the tools available to you, and never be afraid to step back if something doesn't feel right. After all, in this market, sometimes the best trade is the one you don't make. So how do you protect yourself from market manipulation then? The reality is, no one is safe. We've seen how market manipulation can destroy your investments. Remember Alex from our earlier story? He lost almost everything because he didn't pay attention. But it's not just newcomers who get caught in these traps. Even traders with years of experience can be blindsided if they're not careful. This is how we protect ourselves. Staying safe in the world of crypto starts with doing your homework. Before investing in any project, take the time to research thoroughly. Look into the team behind it, the technology they're using, and whether their goals seem realistic. This kind of due diligence can help you spot red flags before it's too late. Also, pay attention to what's happening on social media. If you see a sudden flood of hype around a project, ask yourself, why? Is it genuine excitement, or is someone trying to create fear of missing out? Jumping into investments based on social media buzz can leave you vulnerable to manipulation, like pump and dump schemes. A smart way to protect yourself is diversifying your portfolio. Don't put all your money into one project. By spreading your investments across different assets, you reduce the risk of being really impacted if one of them falls victim to a scam. Finally, set clear, realistic profit targets for yourself. Knowing when to take your gains and when to step back is crucial. Use the tools available to you like stop-loss orders and portfolio trackers. These strategies help you stay focused and avoid getting caught up in the emotional swings of the market. Market manipulation in crypto is real, but don't let that stop you from making profit. Your best defense is knowledge. The more you understand these tactics, the better you can protect yourself. And here's a challenge for you. Keep learning, stay curious, and never trust what you see in the markets. Follow respectable crypto analysts, explore on-chain analysis tools, and never stop asking questions. What are your thoughts on this? Share your tips or questions in the comments below. And if you want more crypto insights like these, hit that subscribe button. Stay informed and trade safely.